Hi, everyone. Welcome to today's live session, Instant Insights in Asset Review, Surfacing the Signals That Matter. So glad you could join us today. Quick housekeeping, the session will run about 30 minutes. We'll spend the first 5 minutes getting some context set up and a couple of slides. Then we'll dive into a fireside chat with Becca and Anthony. After that, we'll leave time for Q&A at the end, so please use the Q&A panel throughout the session. And yes, today is being recorded. You'll get the replay in your inbox tomorrow, so no need to worry if you miss anything. So I am your host today, but really the spotlight belongs to our two speakers here. So rather than me stealing their thunder, I'll let them introduce themselves directly. Anthony, you can kick it off with you.
Sure. Thanks, Rana. My name is Anthony Macko, and my light just flashed in my face. I'm a senior account manager here at Ocrolus. And prior to my time here, I actually was in the mortgage industry for about 14 or so years. Most of it in underwriting, a little bit of time as an LO. But now I work with our clients, partnering with operations, underwriting, IT to remove bottlenecks, drive adoption of technology to increase efficiency, productivity, and ultimately borrower experience. And Becca, go ahead.
Yeah, and hi everyone. My name is Rebecca Seward, and I lead mortgage product development here at Ocrolus. I came up through both the lending and technology sides of the industry. I have over 13 years of experience working with mortgage lenders and fintechs. And similar to Anthony, I work directly with our customers to help turn some of what we believe to be the most manual underwriting tasks into truly scalable, efficient workflows. We try to help lenders operate smarter, reduce their risk, and better serve their borrowers. So we're excited to chat with you all today. So before we get started, we just wanted to do a super quick poll with the group here today. Answer as best as you can with the options that you have in front of you. All we want to know is which department do you represent?
This is where the Jeopardy music comes on, usually.
All right, awesome. So we've got a lot of underwriters here with us today, but also a pretty good distribution of loan officers and tech partners as well. So thank you for joining us. We're super excited to talk to you all today. All right, so getting right into things, we want to talk through a little bit about how lenders' priorities have been shifting over the last 3 years. So in 2025, we are actually starting to see a major shift in what lenders are prioritizing from a business outcomes perspective. For the first time in over 3 years, business process streamlining has moved ahead of costs cutting as the top priority. So I think what's even more telling is that significantly more lenders are now seeing back-end process technology as a true critical investment area. So that shows us that this industry isn't just looking for short-term savings anymore. It's actually focusing on long-term efficiency, scalability, and as I was mentioning before, the ability to reduce risk. So that doesn't necessarily mean that cost savings have fallen off the list completely, right? It's still obviously very important for us to all be mindful of costs. But I think what is changing now is that lenders are recognizing that the ability to streamline their workflows and automating things like data validation, modernizing some of the ways that they are processing a loan application are all lead measures to create cost savings. So I think for us, it's becoming efficiency first, and then cost savings will then naturally follow. So that is the shift that we are seeing in the market today, and how lenders are kind of changing their priorities in terms of what they're focused on and where they're investing.
So today we're here to talk about asset review. And to me, bank statements are kind of like a borrower's blood work. If this makes sense, stay with me. But you can really see what's going on with the borrower's financial life. I think some bank statements you could see what the borrower had for dinner last weekend. You know, hey, I saw you were at Portillo's. So there's just a lot that goes into them. There's a lot that comes out of them. But this means there's a lot to review, right? And that's a difficult thing for people to do. Um, just like with blood work, the earlier you can find something, the better. Early detection is key. You never want post-closing or QC teams to be the first person that's asking about something on a bank statement, right? That's not going to work. But this process is tough. You're finding needles in a haystack, and that's not an efficient process that can lead to longer SLAs, that could lead to unexpected or accidental borrower conditions, friction with the borrower, and generally just an inefficient process. But technology can help, and this is what we have found. So we did do a case study with one of our clients, Neighborhood Loans. And before using Ocrolus, they had pretty standard manual indexing of documents, standard manual income calculations, and it just led to generally longer processing times. After implementing Ocrolus, they automated document indexing, they standardized income calculations, that streamlined workflows. So they measured and saw that processing times dropped. They went from sometimes up to a half a day of a review to a half an hour of a review, much faster, much more efficient. They also found that the average time to close a loan dropped and maintained even as they grew and closed more and more loans, and they didn't need to rely on headcount to be the first go-to move to deal with more volume and closing more loans. And that's exactly what we want to see. That's what everyone wants to see, right? And what that tells us is technology can support mortgage processes. It can surface things that are important, have key data ready for people to make decisions, and ultimately make people work in the area of making important decisions rather than having to be hunters and peckers and looking through documents.
Awesome. Thank you, Becca and Anthony. That gives us a great kind of setup, set the table up to see what the conversation is going to bring us to next. So I'm going to go ahead and pull down the slides so that we can see your faces and then shift into some fireside chat. Remember, if there are any questions that any conversations that spark questions for you, please feel free to drop them into the Q&A panel, and we'll get to as many as we can in the last 10 minutes here. So Anthony, Becca, I'll leave it to you guys to kind of talk about some of the other things we're seeing.
Sure. So I think first and foremost, I have a question for you, Becca. What are the high value signals that we think are worth surfacing quickly to people?
Yeah. So I think the most critical signals that we want to be able to surface quickly are those that are actually going to affect the borrower's ability to qualify for the loan application, or those that inform the borrower's ability to repay on the loan app, right? So we actually spent a lot of time talking to real underwriters. We did a research project, and then we spoke to underwriters of our existing clients, and they told us one thing loud and clear, which was that there are certain components of a loan underwrite that are more manual, that take longer, and are just more tedious for them. So the one area that we honed in on most prominently was asset review. We were told that it's one of the most painful parts of their workflow. And that makes sense, right? Usually a typical QM loan application requires at least 60 days of transaction history. If you multiply that by a borrower who has multiple accounts, that could be a lot of review if you have to go through every single transaction to try to find the things that are actually going to meaningfully impact the borrower's qualification ability. So those same themes just kept coming up over and over again with these customers in these interviews. And that's why the few things that we focused on were asset-driven insights. So two of those things are recurring payments and buy now, pay later services. Buy now, pay later services are coming up more and more often in loan underwriting reviews. It's not always just that you're doing a buy now, pay later service to buy a shirt from an online website. You could also have an affirm payment because you're funding something, a larger purchase. And those don't show up on the credit report. So they need to be surfaced because they could potentially affect the borrower's debt to income ratio at the time of closing, but they're not something that's going to show up on the credit report. So that would be something someone would have to manually hunt down. Similarly, with recurring payments, there are sometimes obligations that don't show up on the credit report or weren't disclosed by borrowers that they want surfaced so that they could compare it to the liabilities or credit report and see if there's any undisclosed debts. The other thing that we heard loud and clear was wage garnishments. Again, liabilities. How does it affect the abilities to pay? If there are child support payments, alimony payments, tax levies that are on the pay stub, those directly reduce stable income for the borrower. And if they're missed, it really changes kind of the whole loan picture. So surfacing those early up was important. And then finally, probably the thing that we heard most commonly was large deposits. Now, Ocrolus, again, not to tote us, but we do have a very mature bank statement analytics product. And customers were coming to us asking if we could identify large deposits based on the loan program thresholds, because those things require supplemental documentation to support. So if you miss them, that could mean weeks later, you're having to go back to the borrower pre-closing. The borrower gets frustrated. The loan officer gets frustrated. The underwriter gets frustrated. It's frustrating for everyone involved. So we really designed this feature set directly around those specific pain points we discussed. And instead of having to spend hours potentially of manually reviewing all the transaction history and combing through those statements, underwriters now get these signals earlier on instantly, and they can move straight to making an actual judgment decision rather than data hunting. So I'll now kick it off to you, Anthony. Which surface insights truly change debt to income versus those that are nice to know?
Tough question. There's some context involved, right? It depends on the borrower profile, the loan type. So if you take a step back, there's generally some categories, and you mentioned these, right? There's large deposits, possible recurring transactions, garnishments. These are the main categories. The trick is figuring out, okay, we've got hundreds of transactions possibly. How do they fit into those categories? There can be things like abbreviations. Some banks will say transfer, others will say exfer, some will say, who knows what. There's a lot of ways things can look, and a big part of the problem is figuring out what category do these things fit into. And from there, we can surface these things. They should be surfaced to people in these categories, possible recurring transactions. This reminds me of, I think it was a few years ago when Tesla financing didn't always report to the credit report, and that was a little chaotic. I mean, could you imagine there could be a $600-700+ payment not on the credit report, and the only way to find it is looking through the bank statement. That can really impact DTI. So these things that happen in the same time of the month, they go to the same person or they're coming from the same depositor. You have to have this analysis. You have to know and be able to identify what category it goes into, when it's happening, in frequency, and technology is great to identify these trends and then just sort of serve them up on a silver platter and say, here's some things, they fall into these categories. You need to make a decision on them, but they might look weird. They might be something that you should take action on.
Yeah. And Anthony, I think I want to piggyback off of that because, your experience in underwriting has really helped us shape and inform this product. My experience in compliance really allows me to understand what the impact of these things are if they go undetected. So, on that note, I guess I'll ask, how do early flags such as this help reduce buybacks and strengthen the audit trail?
So it's like blood work again. The earlier, the better. This is a direct impact on borrower experience. Um, the earlier, the better that some of these things are found. If a processor, if an LO can be the one finding these things and addressing it with the borrower, that's ideal, right? Um, Borrowers, a lot of times they're buying a house. They are on Zillow showing pictures of their house to their family. They're telling stories about the house. They're on Wayfair looking at furniture. They don't want to hear about a transaction on a bank statement that they sent in 2.5 weeks ago. If it's something that they just sent in, that makes sense. You can answer a question about it. So the timing is so important, and it really impacts the borrower experience. And it doesn't make sense to borrowers when you're asking questions and it's 30 days later. It's a little chaotic.
Yeah, I can certainly agree with that. And I I experienced something similar when I was applying for my first mortgage, when I was requested to provide documentation around a $20 payment that my friend gave me through Venmo. She was just, giving me money back for paying for her lunch. That felt ridiculous to me at the time. Of course, I was understanding that my underwriter was just doing their job. I was working at the lender, so I didn't want to be challenging, but That's why it's so important to be able to surface the right signals and the ones that actually, to our point, only affect the debt to income ratio, rather than having to follow back up with your borrower and requesting details about something that they find, or at least they're confused as to why you're asking for it, right? That's the other piece of this, is that you want to have transparency and provide the information that your borrowers need to explain why you're asking for these things. So that's why it's so critical that we're only surfacing what's important, what actually affects the borrower's qualification abilities, and we're doing it in a meaningful way.
You never want to get the LOEs that come back and they're very blunt and to the point, and it says, we were eating lunch and my friend paid me back. That you can feel the frustration coming through in those type of LOEs.
Exactly.
Uh, so in the world where we're, surfacing data, people that are working through this data, they no longer have to hunt and peck. What are your thoughts on how that impacts a workflow?
Yeah, I really like the hunting and pecking metaphor there. I think when underwriters are able to stop hunting, it fundamentally really changes the way that they work, right? So today, asset review is entirely manual, and it's almost like finding a needle in a haystack where you're having to flip through pages and pages of transaction history, or you're having to look through different pay stubs, different asset documents to find that one thing that matters. And that's potentially hours of detective work. I mean, not typically, but it could very well end up that way, depending on the number of borrowers, depending on the number of documents you're having to sift through. And that's hours spent before you even get to the real actual analysis that you need to make in order to make the right credit decision. So I think by surfacing those signals instantly, we kind of remove that hunt, so to speak, and we allow underwriters to operate really at the top of their license. The human in the loop judgment, we love that term, is definitely still critical, but I think they're the ones who determine, underwriters are the ones who determine whether the large deposit is acceptable, whether it's a $20 Venmo payment that you need to actually ask about, or whether that recurring transaction should actually count as a liability. But instead of them having to spend maybe 80% of their time searching through the transaction history and only 20% of that time actually making an analysis on what those insights mean, we're actually flipping the script for them. We're changing that equation where they're spending the majority of their time just making a decision and making analysis on what those signals mean, and less time actually going on the hunt. So I think that obviously results in downstream effects in terms of faster cycle time, fewer misses that could lead to costly buybacks, and a much better borrower experience. We keep talking about it. That's what we're all ultimately here to serve, is the best borrower experience we can. And we want to streamline our workflows and focus on those things that are all leading indicators for us to ultimately save costs. So, as we were speaking earlier, yes, cost savings are no longer the lead priority for these businesses, but by doing all of these things, it'll ultimately lead to that as well. So, we just want to focus on streamlining that experience. And that just means that underwriters get to focus on what they do best. They get to assess risk, make a decision, and they no longer have to play Nancy Drew. So,
Love the Nancy Drew analogy. So we are right pretty much at time, the last 10 minutes to open it up to Q&A. It's a quiet group today. I have two so far. Again, feel free to drop your Q&A into that Q&A panel on your screen if you have any questions for Becca or Anthony. I will start with whoever wants to take this one. Question is, does this help support compliance, or is the only benefit faster reviews?
I can take that one first, and then Anthony would love for you to add color. As I said, I spent time in compliance, so I would absolutely say that this supports compliance. Again, we're trying to focus on reducing risk ultimately, right? Because if these things are missed earlier on in the app flow, yes, it could lead to time issues later on. But if they go even beyond closing and your investor is the person detecting these things, or your QC analyst is the one detecting these things, that's no good for anyone involved. That can lead to very costly buybacks, sometimes thousands, if not tens of thousands of dollars in penalties. And that's not good for the business. So it absolutely helps with compliance because you are able to reduce risk. You're able to detect the things that could ultimately result in a financial penalty for your business. And then, of course, a benefit of that is that you still are able to shorten cycle times and provide better borrower experiences. So that's why it matters to us, supporting both the business's outcome of wanting to reduce risk and manage your compliance standards. And then also another effect is a better borrower experience and faster cycle times. But Anthony, I'll defer to you to see if you have anything else to add.
I think there's an expectation that folks will come around to having with the part of the review of going through assets. So I can think of this similar to the way of a credit report and what a credit report does, right? It gathers and combines a bunch of data together and serves it up as a report. The alternative to that would be imagine looking through 12 monthly statements for 6 or 7 different trade lines and having to do that on every borrower. Some of them are going to have 20 trade lines and you're looking through all these different monthly statements. Well, a credit report combines that all together and serves it up, and it puts the ones in bold that have problems, or if there's late payments, it's depicted as its own line. It's very clear. You know what to expect when you're opening a credit report. With assets, you might walk into 1,200 transactions and good luck. You got to walk through those now. And that's where technology can help. In the same manner, how a credit report combines all this data and serves it up in a nice, expected way, technology can do the same thing with transactions, with bank statement data, and surface and serve up the ones that are worth knowing about, are worth making this decision about. Is this a recurring debt? Is this something from the IRS? This is from my background in underwriting, what I think is so going to be so nice to have that expectation that this is what I'm walking into. I know what to look for because it's going to be served up to me, rather than having to go through line by line and go through that toil.
Awesome, Anthony. I'll stick with you for this next one because it's pretty similar to what you were just ending off with. Can you share examples of what underwriters should prioritize when reviewing borrower files? Or I'm sorry, examples of the signals to prioritize when reviewing borrower files.
Sure. I think anyone here that's in any level of team leadership management dreads those like post-closing emails, suspense emails, investor suspense. But they can generally come from, at least as it pertains to asset review, a couple of these categories. And we talked a little bit about these too, but these undisclosed debts are the biggest one that stick out to me, right? Something like a garnishment can show on a bank statement. It could show on a pay stub too. But these things that are recurring, they come out of the bank statement the same time of the month, each month. If they're the same dollar amount, they're coming, being sent to the same creditor or person, whoever's receiving it. When you start to see those trends, those are the things that have to be addressed. And if you miss those, you might be getting one of those emails that are dreaded after the loan closes, and nobody wants to deal with those.
Awesome. Okay, one very broader, sorry, I shouldn't say very broad, one a little bit more broad question, and then I have one very specific product question, actually. So I'll start with the broad one here. How do you see automation changing the role of underwriters in the next few years? Whoever would like to take that.
I'll take a quick shot at it, and Becca, please feel free to fill in.
Of course.
I think so. What I was talking about a minute ago is, as underwriting and processing teams get more comfortable with technology as a sidekick, they'll know what to expect. It'll give a better expectation for how long the whole review should take. And it's changing. It's been changing and it'll continue to change, where as people lean on technology, and those people on the team that lean on it and use it are the ones that are going to, their heads are going to rise above the crowd. You have a better expectation of what it is you need to do and what it is you can rely on the technology to do for you. And that'll fast forward you to making decisions faster, which is ultimately where we want people to live. We want to surface things up, find things that are worth putting your eyes on, but we'll go through the toil. We'll go through those 1,200 transactions or whatever it may be. You will know what to expect coming out of this and how to lean on the technology.
Yeah, and I think what I would generally add to that is that I feel having worked in this space for some time and attending conferences, talking to other technology vendors, I do truly believe that the general sentiment across these tech vendors is that we want to be able to empower the human decision makers. We've said this multiple times in these webinars before, but ultimately, we're not here to displace processors and underwriters. We're here to level them up and to allow them to operate at their highest capacity. We do not want them to be hunters and gatherers going through transactions and going and calculating income in an Excel spreadsheet. We want them to be able to be surfaced with decision-ready data and then use their expertise and their specialized experience to make informed credit decisions. So that's really where I see the industry taking these positions of processing and underwriting. You're not having to comb through documents and be a Nancy Drew, but you're actually someone who's going to have decision ready data in front of you, have a loan file that has been combed through and has surfaced all of these different signals to you that matter and that will affect the borrower's qualification abilities, but you're going to be in control ultimately of the final decision of whether or not that borrower is approved. And that allows you, again, to provide better borrower experiences. It allows you to actually spend the time doing what you want to be doing, which is making risk decisions, instead of being someone that's trying to find the needle in the haystack or combing through documents or sorting documents into buckets or whatever it may be that you're doing manually today. Technology is here to eliminate a lot of those remedial tasks that are entirely manual and very time consuming that you do not want to spend your time doing. And it allows you to spend more time on the actual high value decision making skills that you need.
Awesome. We have two more questions. They are product related, so I'm going to bucket them together. And Becca, I'll direct them at you, and then we can wrap up right after that. So, first question slash comment: love the enhancement. Is this available now? And then the second question that came in similarly is this a specific AI model trained on finding and pulling out financial data from banking statements for mortgage underwriting?
Yes, great questions. In terms of timeliness and when this will be available, we are launching this in production on Tuesday of next week for our existing customers. So super exciting news there. We'll be sharing more information with the customers of ours who are on this call via email, as well as release notes and docksite updates. So all of that good information will be publicly available next week. And then in terms of, sorry, the second question was an AI model specifically for mortgage lending. Yes, I would say that we created some deterministic rule sets that allow us to identify these capabilities specifically for mortgage lending. That doesn't necessarily mean that detecting undisclosed debts couldn't translate to other lending verticals. Specifically, consumer is one that comes to mind. If you have a source document and you need to be able to compare, is this liability on the credit report, for an example? Today, it will be available for our clients who are leveraging Encompass because we have access to the liabilities section. And so that is a specific mortgage customer profile that we have today. But as we grow, we obviously want to expand our offerings beyond just one specific delivery mechanism. We want to make it available via APIs so that other lenders who might be interested in seeing these types of insights could access them. We do also have, via our bank statement transactions, the ability to uncover things like recurring debts and buy now, pay later services. So those are all publicly available transaction tags that our customers can leverage today. This is just a more productized version of that that is specific to mortgage lending.
Wonderful. Thank you. So it looks like we are at the top of our time together. So let's do a lightning recap of what we heard today. One, instant insights surface the signals that matter, replacing manual data hunting with clear, actionable cues. Two, automation standardizes review and accelerates decisions, giving teams more time for judgment and risk. And lastly, modernized workflows improve the borrower experience and set lenders up to scale and adapt as the market shifts. So on behalf of Becca, Anthony, and the whole Ocrolus team, thank you so much for joining us. Keep an eye on your inboxes tomorrow for the recording, and we will see you at the next session. So have a great rest of your week, everyone. Thank you.
Thank you.